Welcome, and thank you for joining us today for our presentation on U.S. expansion through acquisition. Hopefully everyone's grabbed their lunch and something to drink while joining us. I'm Carolyn Powell, Business Development Director here at Tronconi, Seguer & Associates. I'll be your host today. Tronconi, Seguer & Associates' mission is to provide the best and most appropriate and professional accounting, audit, and tax consulting services in the industry. We work with many international-based companies, many of them being Ontario and Quebec-based, as they expand into the U.S. Many times, business owners prefer to expand via acquisition of an existing U.S. operation. Today, I'm joined by Mark Ferm and Jim Frank to talk further about considerations when looking at an acquisition opportunity in the U.S. We will start our discussion with things to think about when considering expansion through acquisition, finding the right opportunity, and completing the due diligence. That will follow with talking about cross-border due diligence items and things to consider when having a U.S. sales operation and employees. We will cover the high points, giving you what you need to know to get started. We'll leave time at the end for Q&A. Feel free to type questions into the question box in the sidebar during the presentation, and we will get them answered at the end. We will also provide Mark and Jim's full contact information at the end of the presentation if you'd like to follow up with them directly. So without further ado, I'll turn over the presentation to Mark to get us started.
Great, thank you, Carolyn. It's a pleasure to be here this afternoon now. For those that are here on the East Coast. And welcome everybody. We appreciate your time today to hear some insights on cross-border transactions. My name is Mark Ferm. I'm a partner with Tronconi, Seguer & Associates that specializes in mergers and acquisitions. And I'm very happy to have Jim Frank with me here this afternoon as well. He's a partner in our tax group and has just a wealth of experience with cross-border transactions. Particularly in the area of taxation. I know that's something of high interest, particularly with cross-border transactions. So I'm really looking forward to him sharing his commentary with the group this afternoon. So what we're going to talk about today, our agenda is to kind of walk through a typical transaction timeline, the different steps, and for those that have maybe done an acquisition in their country of origin, this may sound very familiar to you, but I think our hope today is to share some insights and point out some unique things of doing transactions here in the U.S. through the lens of U.S. practitioners. So we'll walk through that. As we make our way through the discussion, we will point those areas out for your consideration. So a typical transaction timeline, multiple steps. One of the common things that come up at the start of a potential acquisition is many people's desire to close the transaction very quickly. And so we want to close in 30 days. We want to close in 60 days. And so what we advise our clients is it usually takes a little bit longer than that, maybe not 6 months as depicted here on the timeline, but it does take more time, particularly here in the U.S. with some regulatory and compliance issues that you have to take a look at before closing a transaction. So some of those more common or unique things that might be different than, say, in Canada, being environmental laws here in the U.S. can be quite stringent. And so if you're looking at a manufacturing company as an example, as a target, it may take some time to look at the potential environmental liabilities here in the U.S. Some of our labor laws can be quite complex, so looking at those labor laws and if there's unions involved, again, just takes a little bit more time and diligence to ensure that you're not taking on consumer liabilities with acquiring any business. And one of the things that we find different, a common question I get, particularly from companies coming from Europe, is what Europeans refer to as dilapidation liabilities, where you have exiting leases or you have lease liabilities associated with those arrangements. And they're not as stringent here in the U.S. with that. I mean, there are some considerations if a target is looking at exiting leases, but that's really not as arduous as, say, you'd see in the UK. So it's a typical timeline, and we'll walk through each of these and point those areas of concern out. So initial contact, this is when first discussing a potential acquisition with the executives and owners of the target company, and I think some of the things to consider are, what are the objectives of the seller, and try to identify those. It's important to understand what they want to get out of the transaction such that you can make a determination as to whether or not you can meet their expectations. And then collecting preliminary information on financial performance, what the legal structure is, and some of the future prospects, what the industry looks like, how the business is performing, and what the projected financial outcomes look like in the coming years, just to get a sense of the viability of the target as a transaction candidate, as well as to help inform the potential buyer about what its offer might be for this type of business. So then doing a business assessment and planning for the acquisition, some of the things to consider, what type of valuation based on the preliminary information that you received. How do you want to structure the deal? And we're going to get into asset versus stock transactions in a little bit. What is the structure of the deal, and what other types of information are important to formulate what's going to end up being in a letter of intent that you're going to provide the seller with the significant proposed terms and conditions of the sale. And then what I would say, what maybe most important phase is try to define what I call the magic. And the magic is really what makes this company valuable. Is it people? Is it intangible assets? Is it know-how? Is it a customer list? And what part of that magic is transferable in a transaction? And one of the things that gets trickier is if you have key people that are non-owners. And so having understand what's creating that value is significantly important, whether or not that can be transferred upon sale. So the objective of this assessment is to formulate really a purchase offer, and it's considering many different factors. What is the market position of the company? What is the financial outlook? What is the EBITDA and cash flow? Many times the EBITDA referred to as earnings before interest, taxes, depreciation, and amortization. That is a common metric used to value a company. They're usually expressed in a multiple of EBITDA. And what are if you're looking to do a synergistic acquisition for a company in your line of business, what are the synergies, if any? Those become maybe a little bit more difficult when you go cross-border because you're dealing with distance issues and border issues. We're all living in a pandemic these days, and being able to cross the border is difficult in most cases. So, those potential synergies, if they're being considered, factoring those limitations. And then what is the assessment of management personnel? This becomes particularly important with smaller acquisitions, with a single owner who is a key person. Who is behind that owner that can help run the business after the seller sails off into the sunset to spend some time on the beach after selling the business. So in the assessment, a couple other things to consider is how to finance the acquisition. This will be a key area for cross-border transactions, and I know Jim will probably touch on this in tax consideration. But how much of the acquisition will be financed by debt versus equity infused by the buyer? There's some important considerations for not only tax, but also depending on the bank that you work with. What are the potential impact of restricted covenants? Many times banks will indicate you cannot pay profit distributions and or repatriate profits cross-border because they want to protect their interest in that loan. And so it's understanding what those limitations are, and that could help inform you about how to structure the transaction and how much debt and equity to include in the capital stack for the deal. And then, but there's other opportunities that if there's limitations there, that maybe the seller can take a note, which we refer to as a seller note, to help finance the transaction for a period of time. So those, I wanted to maybe turn it over to Jim here quickly to maybe talk about some of the tax considerations, particularly related to debt and equity.
Thanks, Mark, and hello, everybody. It's great to be with you this afternoon. Just a couple comments on the tax considerations on financing the acquisition. Assuming that you either acquire a U.S. entity or that you form one, you can leverage your U.S. operations by making the U.S. entity the primary obligor of the debt incurred to finance that acquisition. In the U.S., there are no statutory debt-to-equity ratios from a tax perspective. Rather, the U.S. tax standard is what is a reasonable debt load of the U.S. entity under the circumstances. Generally, 100% debt capitalization is not going to be viewed as reasonable, so you should plan on some level of share capital in the U.S. entity. Again, it needs to be a reasonable amount. The U.S. does have limitations on the deductibility of interest, the so-called earnings stripping limitations. Under the current law, assuming your affiliated group, your worldwide group, generates $25 million or more in revenue, beginning in 2021, the deductible business interest, net of any interest income you might generate, is limited to 30% of a figure that roughly equates to EBITDA, that measure that Mark was referring to, earnings before interest, taxes, depreciation, and amortization. However, beginning in 2022, that figure serving as the basis for the limitation is further reduced to just EBIT, that is, earnings before just interest and taxes. But even if you're financing the acquisition internally, you should strongly consider leveraging the U.S. entity with intercompany debt across the border. The reason for this is that it's easier and potentially less costly to move debt service payments back to Canada. This is because of the Canada-U.S. Income Tax Treaty, which provides that there is no U.S. withholding tax on interest payments to the Canadian creditors. The statutory U.S. withholding tax rate is 30%, but the treaty drops that to 0. And of course, principal repayments of debt also don't attract any withholding taxes. Now compare that to withholding tax on dividend distributions. Under the Canada-U.S. Tax Treaty, and dependent on whether a U.S. corporation is owned by a Canadian corporation or by Canadian individuals, withholding tax on dividends could be 5% or 15%. And under U.S. tax rules, you don't get to pick and choose what type of equity is being returned to Canada. If a U.S. corporation has accumulated earnings, any distribution made by that corporation will always be considered to come out of such accumulated earnings first, and therefore it will be subject to U.S. withholding taxes. Mark?
Yeah, thanks, Jim. Just to add on to that discussion of interest limitations, we do find that coming into play, particularly with private equity-backed, highly leveraged transactions, where the thesis is to try to use other people's money to acquire the business to increase returns to the shareholders. The more debt that is used to finance a transaction, the more likely is you may have interest limitation, and that should certainly factor into the tax planning discussions of any proposed transaction. Moving on to the structure, we're going to discuss the potential business, the different structures that can be utilized. We'll speak at a high level here today. There's really asset transactions versus stock transactions, the two broad categories we're going to talk about. And then in an asset purchase from a buyer's perspective can be beneficial. It allows you to select specific assets to acquire and then limit the types of liabilities that you will incur. And then, one of the significant considerations in the U.S. is the tax implications to that. So I'll just turn it over to Jim real quick here to talk about the implications of an asset deal in regards to tax.
Focusing on the seller, and thanks, Mark, this can drive the economics of the deal and certainly the negotiations as well. If the seller is an individual or a flow-through entity owned by individuals, assuming that there's going to be gain to be recognized on the transaction for the seller, they will want most or all of it to be capital gain. Why? Well, because under U.S. tax law, there's a preferential federal tax rate for individuals on capital gains of 23.8%, and compare that to the top marginal tax rate on ordinary income of 37%. So you can see they're going to have a motivation. So they want to allocate as much of the purchase consideration to assets in which gain recognized will be capital in nature. And this is usually going to be things like real estate and intangibles. Now, those type of assets are going to have a slow amortization period, so that's probably not where the buyer is going to want to allocate as much as they can in terms of allocation to assets. The buyer will probably want to allocate to things such as inventory, which turns quickly, or machinery and equipment that gets written off quickly. So if the seller is a corporation, the character of gain or loss is less important because there is no capital gain tax rate differential for U.S. corporations. All income for U.S. corporations is taxed at a flat 21%, irrespective of whether it's capital or ordinary. Therefore, a corporation will generally care about generating a capital gain only if they have a capital loss carry forward to shield that gain. Mark?
Well, thanks, Jim. Appreciate that. And as Jim had mentioned, there is typically a sort of a competing interest here with the buyer and seller. And, many times the buyer may prefer an asset deal, whereas a seller many times might prefer a stock deal. So in terms of one of the other major structure opportunities is a stock transaction as opposed to an asset deal. And in a stock transaction, one of the keys here is you are assuming all the liabilities of that target company. And as we mentioned before, with the environmental liability being relatively stringent here in the U.S., that is one example of a consideration, particularly for manufacturing companies, that in a stock deal you're acquiring that liability, as well as all tax liabilities too, whether paid or unpaid, or in some cases contingent tax liabilities you're not aware of. And we'll get into some of those little hidden taxes here, which will make a U.S. transaction a lot more unique, especially for those coming from Canada. So in the stock transactions, a couple things to consider. There would likely be a working capital delivery that can be pretty complex to calculate what that might be. And as we mentioned, a legal liability carryover. And then as part of drafting the purchase agreements for the transaction, it's important to understand what those liabilities are so that the attorneys can craft appropriate indemnification clauses on behalf of the buyer. So if any liabilities were undisclosed by the seller, then there's indemnification for liabilities that occur post-transaction that we become aware of. Other financial tools that we use to support that is having escrows and holdbacks. And so part of the purchase price being held back until contingencies are known. And if the contingencies do arise, then we can take money out of those holdbacks in order to satisfy those contingent liabilities. Another tool that we're seeing become a little bit more used here in the U.S. is tail insurance. To the extent that there is significant unknown contingent liabilities, or maybe even something discovered in diligence, the buyer may request or could request the seller to purchase tail insurance to cover those contingencies. I will say, though, that tail insurance tends to be very expensive, so that'll be something to consider. Typically in escrows, we see here in the U.S. probably maybe an 18 to 24 months is a typical time period, sometimes as short as 12, again, depending on the risk profile of the target. So I'm going to turn it back over to Jim. He's going to cover some areas of taxation.
Thanks, Mark. Again, assuming a premium is going to be paid for the business being acquired, asset acquisitions or transactions that can be treated as asset acquisitions, which we'll talk about in a little bit, will generally be favorable to a buyer, as they'll be allowed to step up the tax basis of the assets to their fair market value, which of course provides greater tax shield against future income. The U.S. has ordering rules as to which assets are allocated, purchase consideration first, which both the buyer and the seller are to follow. And this can result in goodwill, which for U.S. tax purposes is amortizable over a 15-year period. As previously indicated, given the seller may be motivated to maximize his capital gain, this can cause that tension between the buyer and the seller when negotiating purchase price allocation. If you find it necessary to acquire the entity that contains the target U.S. business, you should be cognizant of the U.S. tax treatment of the type of entity that you're looking at. Like in Canada, partnerships are flow-through entities. However, limited liability companies, or LLCs, absent an election to the contrary, are also treated as flow-through entities for U.S. tax purposes. So in the U.S., if there's multiple owners of an LLC, that LLC is going to be viewed as a partnership. If there's a single owner, then that LLC is disregarded for U.S. income tax purposes. That the owner is viewed as holding the assets and earning the income that's generated by that LLC. So if you acquire 100% of the outstanding interests of a partnership or an LLC, this will automatically be viewed as an asset purchase for U.S. income tax purposes, and you'll have the opportunity to step up the basis of the underlying assets. In such a situation, you want to strongly consider having a U.S. corporation be the direct purchaser, however, as the partnership will cease to exist. Furthermore, as LLCs are viewed as corporations for Canadian tax purposes, but flow-through entities for U.S. tax purposes, they're viewed as what's referred to as hybrid entities in the cross-border context. As such, they may not be qualified to receive the benefits of the Canada-U.S. income tax treaty. Given this, you'll want to make sure whatever entity you end up with in the U.S. will be treaty benefit eligible. Let's talk for a second about S corporations. S corporations are just regular incorporated entities that meet certain ownership requirements that allow them, via an election, to be treated as flow-through entities. So they're corporations that are flow-through entities. Unlike partnerships and LLCs, however, if you acquire the shares of an S corporation, that does not automatically get treated as an acquisition of the underlying assets. In such a situation, the sellers will be viewed simply as selling their shares, and they'll recognize capital gain. For S corporations, the buyers and sellers can elect under our Section 338 to treat the share purchase as a purchase and sale of the S corporation's underlying assets, which of course would support a step up in the basis of the assets for the buyer. For the selling shareholders, there would still be only one level of tax, as any gain on the deemed asset sale would flow out to them to be taxed. However, and this is an important consideration, this could change the character of a large portion of the such gain from capital to ordinary. So now the deal may have gotten more expensive for them because the ordinary income is going to get taxed at a much higher rate. Regular C corporations, of course, are not flow-through entities. An acquisition of a C corporation shares will generally result in the purchase price becoming the purchaser's tax basis in such shares. It doesn't provide any future tax shield. A purchaser of C corporation shares can elect to treat such an acquisition as the purchase and sale of the underlying assets. While this does support a step up in the basis of such assets, the tax on the deemed sale of those assets by the corporation falls on the purchaser. Because of this, Generally, a purchaser would only make such an election if the target had carry-forward tax attributes, such as tax losses and credits, that could be used to offset the effect of the gain on the deemed asset sale. Thinking about some of the cross-border tax implications on structuring a deal, if you make an acquisition in the U.S., you definitely want to consider your Canadian tax structure as well, and what entity in Canada will hold the U.S. operations. It's been our experience that a Canadian corporation is utilized to hold the U.S. operations, irregardless of what form of entity is utilized in the U.S. Where the overall businesses are privately owned, more and more we have seen and advised on the use of a separate Canadian holding company to hold the U.S. operation, as opposed to the U.S. operations being stacked underneath the Canadian operating company. Our attorney friends, I believe, would say that the use of a separate holding company would be beneficial in isolating any potential legal liability issues. But whether a separate holding company or stacked within a larger corporate group, you want to make sure that the ownership and or the operations of the Canadian corporation holding the U.S. operations supports its eligibility for the benefits of the Canada-U.S. income tax treaty. These benefits include the reduced U.S. withholding taxes on items such as interest and dividends that we've talked about previously, but also on potential cross-border royalties, license fees, and in some cases, rentals. Qualification for treaty benefits also supports the Canadian corporation and its U.S. subsidiary to request what's called competent authority assistance relative to any cross-border transactions. The competent authorities in this case is simply Canada Revenue Agency in Canada or the Internal Revenue Service in the United States. We most often see competent authority assistance requests in transfer pricing disputes on intercompany product sales. Should one or the other countries propose an adjustment to taxable income of the entity resident in their respective country that could result in the imposition of tax on the same transaction on both sides of the border, i.e. double taxation, requesting the competent authority assistance of the other country gets the CRA and the IRS to talk to each other and negotiate the split of income on that intercompany transaction so that there is no double taxation. If your Canadian corporation is required to buy the assets of the target U.S. business or the outstanding interests of a partnership or an LLC, absent forming a U.S. corporate subsidiary to make that acquisition, this will likely result in a taxable branch in the U.S. Under U.S. rules, a Canadian corporation operating in the U.S. through a branch is subject to the normal U.S. federal corporate income tax rate of 21% on its U.S. branch taxable income. In addition to this income tax, there's also a U.S. federal branch profits tax imposed on the repatriation of the accumulated branch profits when they go back to Canada. You can kind of think of this as equivalent to a U.S. withholding tax on a dividend distribution from a U.S. corporation. Assuming the Canadian corporation is treaty eligible, the rate of this branch profits tax is reduced to 5%. The treaty also provides that the first $500,000 of branch accumulated earnings, and that's measured in Canadian dollars, is exempt from the branch profits tax. As noted previously, because of their hybrid nature, a disregarded LLC viewed as a branch for U.S. tax purposes may not be eligible for the benefits of the treaty. In this case, the branch profits tax would be imposed at a U.S. statutory rate of 30%, not the 5% under the treaty, and there would be no exemption for the first $500,000 of branch earnings. Under the U.S. entity classification rules, you can elect to treat the LLC as a corporation. If you did this, the treaty eligibility would be restored to the LLC. which would be treated simply as a corporate subsidiary of the Canadian parent for U.S. tax purposes. As such, the branch profits tax wouldn't be applicable anymore. A few other things to note. What can happen depending on the type of entity that you're dealing with in the U.S. If you acquire the shares of an S corporation, whether or not an election is made to treat the acquisition as an asset purchase, immediately after closing the acquisition of the S corporation, it will revert to a regular C corporation for U.S. income tax purposes. It won't be a flow-through entity anymore. This is due to the fact that S corporations can only be owned by U.S. individuals and certain trusts whose beneficiaries are U.S. individuals. U.S. federal tax does allow the filing of U.S. consolidated corporate income tax returns for U.S. corporations that are under a common U.S. corporate ownership. So if you're considering making multiple U.S. acquisitions and transactions, you could consider forming a U.S. holding company to own multiple U.S. corporations, and this would allow you to file a single U.S. corporate income tax return. In addition to reducing the number of federal corporate income tax returns that you have to file, having a U.S. tax consolidated group can make the movement of funds, products, services amongst the U.S. entities a lot easier from a tax perspective. Important thing to note is that the various states do not have to follow the U.S. federal income tax treaties. I know that's surprising to many Canadians, but under the U.S. Constitution, states are sovereign, and therefore they can impose their tax regimes on any business that's conducted within their borders as they deem appropriate. So of the 47 states that impose some level of tax on income, about half do not follow federal income tax treaties. The other half have administratively determined that U.S. federal taxable income is the starting point for the imposition of their state income tax. And we see such differences among the states become really apparent if the Canadian corporation operates its U.S. business as a branch. Some states will follow the U.S. federal branch determination of taxable income, while other states require that the Canadian corporation's entire worldwide income be determined under U.S. tax principles, and then that gets apportioned to the state for the imposition of its corporate income tax. So maybe a disadvantage to operating in the U.S. as a branch. Mark, I think you want to talk a little bit about letter of intent.
Yeah, sounds good. Thanks, Jim. And I think that all what Jim was discussing, obviously, the importance of the legal structure and tax structure of the proposed acquisition company, or if so, directly acquired by a foreign company. But some implications to consider, not necessarily prior to issuing a letter of intent, but I think that planning can be hugely important to understand what that structure might look like. And so with a letter of intent comes with it, considerations, or what's included in a letter of intent is the purchase price, any significant terms and conditions, contingencies to close. This is, I think, an important area for cross-border transactions. One of the contingency could be the obtaining appropriate financing. And again, we talked a lot about what level of financing and where is that money being borrowed from, and just taking probably a little bit extra time in cross-border transactions to get the deal through the bank, so to speak, and get them comfortable with the structure and valuation. There'll likely be a no-shop clause so that the buyer has a period of time to do its due diligence, so that the seller cannot shop the business to other potential buyers. But the letter of intent, even though a legal document, it is non-binding. It does not bind the parties to the transaction, but it should outline significant terms and assumptions. I think that becomes very important after diligence is done. If there's any discrepancies or disputes between the confirmatory due diligence and the letter of intent, the letter of intent can help as a guide to guide how those negotiations will take place prior to the signing of the purchase agreements. So other things to consider with the letter of intent, of course, we mentioned the proposed purchase price, but there's certain working capital can be a tricky area. As part of the valuation of the company, most buyers will anticipate the delivery of a certain amount of working capital, and how that's defined in a letter of intent can be important. Typically, what we're seeing is for that term in a letter of intent to be a little bit more generic until we're able to do confirmatory due diligence to really understand the components of working capital prior to establishing any threshold. And so what then the purchase document will say is there's a certain level of target working capital that needs to be delivered at close. Otherwise, there's an adjustment to the purchase price. So then the letter of intent will also provide a period of time. The buyer doesn't get forever to perform the confirmatory due diligence. It'll outline the number of days that the buyer gets. Usually, we're seeing usually around 60 days, and then might also target a closing date, which can be 30 to 60 days after that. That can vary, really depends on the transaction. It can be shorter. It really depends on, the complexities of the seller as well as the objectives of both parties. So in confirmatory due diligence, the next phase is to really verify the information that was utilized to establish the purchase price and any other significant assumptions that were used in the letter of intent that needs to be validated in due diligence. And it would generally include looking at the business itself. And one of the common areas that we find is somewhat neglected, if you will, is operations. Operational due diligence can be important, and because the transaction typically revolves around a financial transaction or the way that it's viewed and its tax implications, much of the time is spent there and legal due diligence, but operational can be just as important. And then, of course, on the legal side, again, we had mentioned a couple areas, the environmental liabilities that could be discovered in diligence, and factoring in enough time to understand those liabilities. And many times there may be a phase 1 study that's ordered, and many times might be actually ordered by the bank who is financing the transaction, may order, and most of the time orders that environmental study to be done. I see so many times where even if something really small is found in a phase 1 study, it becomes a red flag, and many times the parties will then want to proceed to a phase 2. Not all the time, but sometimes. And so again, it's just more time that clicks off the clock to get those studies done to understand what the exposure is for the buyer. The financial and accounting due diligence is a focus on quality of earnings, looking at the historical earnings and how consistent are they, and are they sustainable given today's environment. I know that one of the things that we're seeing quite a bit, we're very, very busy on the transaction front, and we're actually seeing some companies having record years. And so the expectation of the seller is, well, my valuation is going to be significantly higher, but if that run up in earnings is related to the COVID pandemic. One example being we have an e-commerce company that specializes in technology products, and they saw a significant increase in business related to people now needing to work from home. And so they're buying extra monitors and mouses for their computers and speaker phones and things like that to work from home. They saw a significant increase in their earnings, so their expectation was the sale price was going to be a lot higher. But a buyer will many times discount that run-up if it's considered to be non-recurring to a certain degree, or just a temporary increase in sales. So it's looking at, how sustainable are they? And are there any non-recurring expenses or income that need to be ignored as part of that earnings base? And are there, especially for smaller businesses, owner expenses running through the company, such as automobile expenses, club memberships, and so forth? So it's really trying to get an understanding of earnings, looking at accounting policies to see how strong they are. If the accounting practices are weak, what types of investments in people and systems need to be made to shore those up post-transaction? What does EBITDA look like that really kind of delves into the quality of earnings? Working capital, how strong is it? Are there issues with inventory or accounts receivable? Are there unrecorded reserves and other commitments and contingencies that have been unrecorded? Of course, our favorite topic today seems to be environmental, but again, I see that creep up on so many transactions. I like to put a focus on that. So Jim, you want to take us through maybe some tax diligence considerations?
Sure would. Thanks, Mark. Well, as with all due diligence exercises, tax due diligence seeks to verify that basically things are as they seem relative to the target, and that any additional risks or liabilities are identified that haven't been before. In the income tax area, the most significant due diligence effort occurs if the target is a U.S. corporation, whether it be a regular C corporation or an S corporation. Relative to S corporations, we do spend a fair amount of time evaluating whether the target corporation maintained its eligibility to be an S corporation flow-through entity. If it hasn't, substantial corporate level income taxes that may not be reflected in the financial information evaluated could occur. The situation could also negatively impact the ability to elect to treat the transaction as an acquisition of the underlying assets. That's that Section 338 election that we talked about before. For C corporations, we generally evaluate the accounting methods that they utilize in determining taxable income. These accounting methods are mandated by the tax regulations, not what is used for financial statement purposes. For example, many smaller U.S. corporations or corporations that are involved in rendering professional services are allowed under the tax regulations to utilize the cash method of accounting. If they were not so eligible, unrecorded income tax liabilities could be the result. So overall, we seek to verify that the target corporation is reflecting revenues as taxable and taking deductions as allowed in determining its income tax liability. We also seek comfort that the target is reporting its taxable results in all the states that it should be. This is generally based on the concept of state nexus, that is, the attachment to states, whether through physical operations or economic activity. Another very large area focused during tax due diligence is state sales and use tax. Notice that this is imposed by the individual states, and in some states, the counties and municipalities therein, not the U.S. government. As a result, every state, and in some states, the counties and municipalities have their own rules and define the transaction that are subject to this tax. Even within state-administered sales and use tax states, tax rates can be different in the various counties and municipalities. As a result, there are over 36,000 separate sales and use tax jurisdictions in the United States. This can make compliance a bit challenging. State sales and use tax is not HST, GST. So get that out of your minds. It does not function like a VAT. There are no input credits. Rather, sales tax is imposed on the end user, at least in theory, of the good or services being sold. However, the seller, in every step of the transaction, the seller has a fiduciary responsibility to collect sales tax and remit it to the states on taxable sale if it does not obtain documentation from his customer that that customer is not the end consumer. If the seller fails to obtain such documentation and fails to collect and remit the tax, he is subject to a 100% penalty equal to the amount of the tax. So in due diligence exercise, we seek to test whether the target has complied with such requirements to charge and collect sales tax unless their customer is not the end consumer. We also seek to evaluate that the target is adhering to the rules in each state where they have economic nexus. The economic nexus is a result of the Supreme Court decision in Wayfair back in 2018, and it's generally based on the number of transactions with customers in a given state or the dollar value of such transactions. Again, each state sets its own thresholds, and note that the tax isn't just imposed on U.S. entities. So if your Canadian corporation is actually exceeding these economic nexus thresholds in given states, your Canadian entity could be subject to sales and use tax as well. You should also note that sales and use tax exposure can apply even in an acquisition of assets. Every state with a sales tax regime has a successor liability provision that makes the buyer of a business liable for the unpaid sales and use tax of the seller of that business, unless certain notification and withholding of purchase consideration provisions are followed.
Yeah, I'd say, Jim, if I could just jump in here, I think in due diligence for Canadian companies, the state income tax and state sales tax complexities are one of the most common, surprises of how complex it is, and that's in diligence that, something to pay attention to because it is complex, and you can, quickly find yourself in significant contingent liabilities, and so having that appropriate assessment done is, again, important, and something that I think a lot of Canadian companies just aren't accustomed to from being up in Canada.
It's very true, and sales and use tax can create and be a much bigger cost to a U.S. business than its income taxes. So it's definitely something to pay attention to. Other areas of tax due diligence that we focus on is the payroll tax area. Payroll taxes are generally imposed by the federal government in most of the states and consist of not only tax withholding from employee compensation, but also federal employee and employer Social Security taxes, as well as federal and state unemployment taxes. Liability for payroll taxes generally attaches to a responsible person as opposed to an entity. And the responsible person, they're generally defined as those folks that are responsible for processing the payroll and also overseeing the processing of that payroll, i.e. the management. As part of this, we also seek to test whether those that the target business classifies as quote unquote independent contractors are not in actuality employees. This classification of such individuals can not only result in substantial additional tax liabilities, but also large additional liabilities for things like employee benefits or mandatory workers' compensation. Some states, but not all, impose a value-based tax on personal property utilized within the state. So as part of tax due diligence, we generally check to see if the target is operating within such states and whether, if they are, they're appropriately reporting the extent of their tangible personal property for assessment by the state. Of course, if the target is a corporation, we'll also be interested in determining if they are complying with foreign tax law for any non-U.S. tax jurisdictions that they may be operating in. This can include other countries' income taxes, VAT, service taxes, any withholding taxes on remittances back to the U.S. parent, things like that. Should also note that the U.S. has, as part of its own income tax rules, extensive foreign transaction and foreign affiliate reporting requirements that are backed up by substantial penalties for failure to comply. So this area also receives attention during our tax due diligence procedures. Mark, do you want to talk about deal documentation?
Yeah, sure. And I think, one of the things in sort of the payroll tax area too that we find common is the documentation of U.S. citizenship can be a common question. And we found a few transactions where that's come up and actually caused a deal to crater because of the lack of that documentation for illegal citizens. So in preparing a deal documentation, just a couple notes here, include many different types of agreements. Maybe one that I wanted to point out that may be a little bit different for Canadian buyers is the notion of transfer taxes. And I think Jim had kind of touched on that a bit, but understanding what types of filings need to occur for bulk sale notices in different states to notify those states that assets are being sold, and that the states will then check to see if there's any taxes due. And if there are, obviously want to make sure those showed up ahead of time. But also there could be imposed a transfer tax on the transferor's assets. So I just wanted to maybe touch on a post-closing deal documentation. As I mentioned before, in some transactions there'll be an expected delivery of working capital, and after the transaction closes, verifying that amount of working capital and the appropriate true up to the purchase price, if any. And Jim, I don't know, could you maybe give us some pointers on some of the tax requirements?
Sure. In the U.S., particularly if you're buying a corporation, it doesn't automatically cut off that corporation's tax year. So you may be faced with filing a tax return that includes the date of acquisition. Well, this is what's referred to as a straddle period return. But whether we're dealing with a straddle period return or even a pre-acquisition return, it's really important to document who is responsible for preparing either the straddle period or the pre-acquisition returns of whatever tax regime, whether it be income, sales, use tax, whatever. So who's responsible for it? Who's going to bear the cost to prepare those returns? And as importantly, for the other party to the transaction that's not responsible for preparing the returns, what rights of review do they have? We always encourage the other party should have a right to review and maybe even object to what's included in the straddle period or pre-acquisition return. And in that case, it's important to also document the parties' agreement as to the timelines as to when these returns will be available for review and how quickly the reviewer has to respond.
So other post-closing activities to consider. I just want to highlight a few as maybe some differences here of how we do business here in the U.S. as employment matters. If you're doing an asset transaction, the need to rehire the employees, they'll be likely employees of a new corporation, and the compliance requirements there can get quite cumbersome here in the U.S. Policy integration and how we do business down here might be slightly different. And so kind of understanding what those differences are and can they be integrated, or should there be differences based on business practices? And of course, system integration to the extent that there's a need for information flow between the subsidiary and the new owner, certainly system considerations there as well. So Jim, for the new entity, I know there's some tax implications there as well.
Yeah, thanks, Mark. Just real quickly, if you're dealing or if you formed a new U.S. entity, you're faced with a whole bunch of registration requirements and, in cases, options. One of the first things you want to consider is, what jurisdiction that new entity is operating in, and whether or not in states outside of its state of incorporation, whether or not you want to register to do business in that state, usually with the Secretary of State. There's a lot of reasons for this, one of which is that it allows that entity to use the state's court system for various reasons should the need arise. If you purchase the assets of a target business, you'll obviously want to be sure to change the ownership title on those assets where necessary. Again, if you're conducting business or you will conduct business in various states, you'll want to register with the tax authority in those states to comply with their laws. Many of the states assign unique taxpayer ID numbers for sales and use, payroll, income tax regimes that'll be necessary to comply with their laws. And of course, speaking of remitting taxes, the U.S. federal government And most of the states mandate that tax remittances nowadays be made electronically. And in order to do so, you generally have to apply for a unique identifier to allow access to the taxing jurisdiction's electronic payment system. So a whole bunch of registration issues you got to deal with, particularly when dealing with a new company. So Carolyn, I'll turn it back to you to bring us home.
All right, thank you guys. Thank you for your expertise on the subject. This was very informative. I even learned a little bit more today. You really broke it down to easy things to consider and think about. We're going to take a look at some of the questions. We have a couple minutes left in the hour here and see what questions people have. If you haven't already done so, just enter your questions into the question box in the sidebar.
Yeah, and Carolyn, I did see actually a good comment from one of our participants here related to phase 1 studies, and that is to mention, typically the bank, the borrower who is borrowing that money, there's usually a pre-approved list of environmental firms that they use. You don't really have a choice per se, so it's a relatively regimented process that takes place in the US. So I appreciate that comment from one of the participants. So do we have any other questions or that came across, Carolyn?
Yeah, it looks like there's a question here. Do I need a business valuation done? Is that something you'd recommend somebody to ask for?
Yeah, we would certainly recommend it. That the level of complexity and or detail need to go into that business valuation can be dictated by many different circumstances. It could be dictated by the investors or shareholders of the buyer. It could be dictated by potentially the bank. There could be considerations in appraisals and valuations for purchase price allocations. And so for tax purposes, it may sometimes be good to have a valuation performed to support the purchase price allocation that's utilized in that purchase price allocation in case the transaction is audited by either the IRS or a state tax authority. So great question.
Great, thank you. Okay, looks like there's one more question here that we can probably squeeze in before we let everyone go. What are some red flags that I should be looking for when going through this process, or anything you've kind of seen from other people's transactions in the past?
Yeah, I think red flags for me is if the seller does not appear to be very forthright with information or slow in providing information, or elusive. And I think that you can usually tell that throughout the process. And I think one of the things that we've wrestled with during the pandemic here is the necessity to perform a lot of our due diligence remotely. And that's been a trend over the last several years to use a quote data room to perform your diligence. But we find so many times where you go on site and just with good business sense and eyes and ears open, you find things in diligence that you wouldn't find just in a data room. So I think that flow of information, honesty, and you can tell that from a seller by being in the same room and kind of observing their body behaviors.
Yeah, one of the things that we pick up on from a tax perspective is there any reinvestment in the business, or are the owners motivated to maximize what they're pulling out of the business? And where we see that maximum pullout, it leads to natural questions. Well, are they so motivated to pull funds out that they may be, shall we say, shortcutting their tax obligations and not complying with tax law?
Great, thanks guys. Those are great pointers for our audience. To stay within the hour today, I want to thank you again for joining us on this topic. Feel free to reach out to us anytime with questions on the material today, but also on other challenges you're facing. Up on the screen is all of our contact information. You can also find Mark, Jim, myself, and Tronconi, Figueroa & Associates on LinkedIn. Follow us to get continual updates and future webinar topics. Thank you again for joining us. Thank you, Mark, and thank you, Jim.
Thanks, everybody.
Take care.